Hello everyone, it's my pleasure to be here with you all today, speaking about markets, speaking about the sectors we like, and also how our portfolios are geared for our views on economy and markets. I think last 23 years that I've been around, I think there's one common question which I face every week, every month is market kya lagta hai? What do you think of markets? And I think here I want to stress upon two things. One differentiate between volatility and risk. Market's volatility cannot be avoided. The volatility is going to be the inherent part of the equity market, and to that extent, market will remain volatile. They will keep on going up and down, and to that extent, as an investor, one should be mentally prepared for a temporary loss of the capital. I think more important and a more relevant piece is to manage the risks. How do we avoid the permanent loss of capital? I think that is something which, with all the research, with all the team that we have, with our experience, we can try and reduce the risk for an investor. And I think that is very important. And to that extent, when you have time with you, over a long period of time where the market will remain volatile, there will be inherent, fall in the markets every now and then. I think in the long run, we have seen the markets have created wealth for the investors. And to that extent, I reiterate that as an investor, one should be more focused on systematically investing in the market, invest into the markets for the long term, and use proper research, use the benefit of the funds management experience that a professional asset management company can offer. I think the investment experience would be more fruitful otherwise when you actually go around and try to invest for the short term. Coming to more recently, a lot of discussion is going around markets at new high. I think that's another classic question. That's another question which I keep on facing is, abhi kya lagta hai when the market is at new high? Here again, I would like to say that while the market values are at new high, the valuations are not. When I compare the markets today versus say markets in October of 2021, when it touched the new high last time around, I think since then the earnings have grown significantly, whereas the markets actually have grown much lesser than the earnings. And to that extent, when I see large cap, when I see mid cap, when I see even small caps, the valuations across the market caps is actually lower than what it was in October 2021. And to that extent, while the markets are touching new highs, the good news is that it is following a very strong earnings growth rate. It is more basis fundamentals, basis recovery in the economy post-pandemic. That is driving the markets, and to that extent, if you ask me, the markets, while they are touching new highs, they are not as euphoric as one would have seen it in the previous peaks or the previous times when the markets have been very, very euphoric. So I think that's one point I wanted to make. Within the markets also, the earnings growth rate is fairly dispersed in the sense that we are not seeing all the sectors doing well at the same time. I think one significant change in trend that we are seeing in the markets nowadays, more recently in last 3 years versus the previous decade, has been recovery of B2B businesses. If you go back before 2020, I think the market was, largely benefiting from growth of consumers and the consumer-facing businesses, as they had not only top-line growth rate but also margin expansion as China was exporting deflation to the world. What is changing more recently over last 2 to 3 years is China, which was an exporter of deflation, is now exporting inflation, in the sense the cost of doing business in China, be it labor cost, be it capital cost, be it environmental cost, everything is going up. And to that extent, there is inherently an inflation in manufacturing, which is in a way has two effects. One, it is positive news for manufacturing industry in China and outside China significantly. but it also means that the input costs for the consumer facing business are going up. So there has been a trend change where the consumer facing businesses earnings growth rate actually is softer than before, whereas the manufacturing industries are growing earnings much faster than before. And I think at the core of our portfolio, we are looking at two things: growth in earnings, but more importantly, growth in return on equity also. I think we are looking for both growth and quality. And not to forget, we are looking to buy growth and quality at a reasonable price. Not at the cheapest price, but at a reasonable price, at a price where it makes sense. So we've been very, very disciplined in our funds management, in our stock picking, in construction of the portfolio, that we kept on looking for businesses where we have earnings growth rate. The capital allocation of the businesses are such that there is structural improvement in return on equity of those businesses. And when that combined with a reasonable valuations is a perfect recipe, is how we see. And that's how we are investing into various portfolios of ours. So I think as far as the economy is concerned, India is far better placed today relative to the rest of the world than where we were in the past. I think from fiscal deficit point of view, from current account deficit point of view, from inflation, interest rates, while the inflation and interest rates are higher, when you compare that with the rest of the world, we are still reasonably priced. That apart, I think the significant part of the macro, if one want to focus on, I think the good news is India has been trying to significantly invest into manufacturing. While, as we all know, services, IT services, financial services, even to some extent in manufacturing, pharmaceuticals and other places, we've been fairly successful. I think where India has been lagging is in general manufacturing, in electronics manufacturing, and that's where through Make in India, through Atmanirbhar, and more recently through PLI, and the competitiveness within the states to attract investments in manufacturing, I think all in all, we are seeing good revival in terms of India Inc. wanting to invest for manufacturing capacities. Parallelly, the profitability of India Inc. has improved, the balance sheets of India Inc. has improved, and more importantly, the banking sector today is in the very sweet spot. The net NPA ratios are all-time low. Capital adequacy looks very, very strong. And to that extent, I think there is a confluence where with China +1 and Europe +1, there's a need for India to invest in manufacturing. India Inc. is ready to invest in manufacturing. India Inc.'s balance sheet is prepared to invest into manufacturing. And most importantly, the banks are also prepared to lend for manufacturing. So I think we are seeing very clearly a confluence of factors which might lead to growth in the manufacturing sector, and to that extent, manufacturing allied industries like capital goods, industrial products, logistics, even banking in that breadth, I would say, would benefit as manufacturing benefits. So, and utilities, of course, the power is a very, very key ingredient. We are seeing significant opportunities and stability of growth in these segments of the market. And we continue to see that the valuations in these areas are selectively expensive, but otherwise broadly fairly reasonably priced. So our portfolio skew towards more manufacturing and manufacturing allied emerges from our outlook that while the consumption and the services piece of the economy was always doing well and will continue to do well, which is richly priced, I think the piece of manufacturing and related businesses which had been lagging behind in last decade, we believe can actually do well, and it's fairly reasonably priced. We're seeing superior earnings growth rate and superior return on equity on those businesses, leading to not only EPS, delta EPS, but also delta P multiple as the return on equity of those businesses improve. With that, thank you very much for your all time and patient hearing. Looking forward to see you again next week. Thank you.